Starting the live now and the webinar in a bit.
Recording in progress.
Good afternoon, everyone. I want to welcome you all to the Tax Resolution Help Center. My name is May. I will be hosting today's session and introducing today's speaker. I will also be coordinating the Q&A chat session at the end of this session. I want to congratulate all of you for taking steps to deal with your taxes from all sources, including income tax, payroll tax, property tax, excise tax, and sales tax. Represent a 35% to 60% reduction in your personal savings and wealth. As you probably know, those with 1% of the wealth in this country have experts to help them pay a small percent of tax. Our goal is to help you reduce how much you pay in tax by educating and informing you on ways to reduce past, present, and future tax expenses. We think you are entitled to live a happier, healthier life by keeping more of what you earn and getting the taxman off your back. Our goal is to provide good information with the opportunity to ask questions that are important to you. The presentation itself will last about 20 minutes, plus 20 or to 30 minutes for you to ask questions by chat. I will select the questions and present them to today's expert. If you wish, you can include your first name and your state. That would be great. Other than that information, your identity is not mentioned. The information you are receiving in this session is not specific tax advice. If you want specific tax advice for your situation, you are free to contact today's expert or any of our tax experts at Tax Resolution Help Center. As you know, these group sessions are included in your do it yourself membership fee of $20 per month. If you are not yet a member, please sign up today. We need your financial support. And of course, to better understand what might be on your mind during the session, I might include some pooling questions to ask you. I will then finish with a 5-minute wrap up. Also, a survey will be sent looking for your feedback. And finally, this session will be recorded. The topic for today's session is filing your tax return, dealing with rental properties, and Schedule E. The tax expert for today's session is John Shantz. John brings a unique perspective as both a business advisor and a business owner. His diverse experience can assist business owners and employees in dealing with everyone's least favorite subject, tax compliance or the repercussions of noncompliance. With that said, introducing John Shantz.
Thank you, May, and thank you, everybody who was here today. Today, we're going to be talking about dealing with rental properties and Schedule E and some things you're going to want to think about with regards to tax filing for your rental properties. A quick little bit about me. Here's my contact information and email address. You are free and welcome to contact me anytime after the session. If you need any additional help or need to touch base or pick my brain, happy to help you out. My background is I started in public accounting, spent the first part of my career in public accounting and tax and audit work. And then I spent the next 25, almost 30 years in real estate development, land development, and successfully retired from that and back in doing some accounting and tax work these days. When I'm not having fun working, I'd rather be skiing. That's one of the loves of my life. I hope you guys and gals all have something you love doing after you're working. So what we want to talk about today is a little bit about rental real estate. What is Schedule E, which is where you report your income and expenses. We'll talk about basis, depreciation, capital improvements versus repairs and maintenance, and the passive loss rules, and how you want to deal with these things so you can file your taxes correctly and take advantage of the tax rules and make them work for you. Rental real estate. Why own rental real estate? You guys may already know this, but you get to use some leverage, mortgages, borrowing money against the value of the asset can work really great as long as you don't over leverage yourself. But for a fraction of the cost of the property, maybe 10, maybe 20% down, you can control a pretty large asset and mortgage the balance. That helps you generate some cash flow and probably some taxable losses as opposed to taxable income. So you could have positive cash flow, but taxable losses, kind of a win-win. Different types of rentals people talk about and look into. A lot of times when we're working with individuals, it's Airbnbs, VRBOs, and then house hacking, buying a house and living in half and maybe renting out the other half, or maybe even renting out 3 or 4 bedrooms in your house and living in one yourself. And those people can help you pay for the house. Maybe you live for free. So what is Schedule E? Schedule E is really the income statement, the income and loss from your rental real estate. It's also used to report income from partnerships and S corporations, but that's not what we're talking about today. Key information on Schedule E, and we'll just go right to our sample Schedule E. This is what it looks like that would spit out of your tax software if you're using tax software to prepare your return or having somebody do it for you. This is where all your income and expenses get reported. You also have to record or note some other information on this form. And that's what the IRS wants to know: if you paid anybody more than $600 and may be required to report or file Form 1099. You're going to need to report what type of property, whether it's single family or multifamily, the number of days you rented it at fair value. You're required to rent the property at fair market value. And then if it's a lot of times if you have a vacation property, and if you're using it for personal use, you need to record the number of personal use days there so you can allocate your expenses properly. Then the form itself, we're looking at the income up here, and then down here is all your expenses. So sometimes, you might want to look at the form just to see all the expenses that you can deduct against the cost of that rental property. It might help jog your memory. Whether you have repairs, supplies, your insurance, any advertising, automobile expenses that you may be able to apply against your rental income, and help keep that income as low as possible, and maybe even generate a taxable loss for the property, which can help you on your help reduce your taxes on your income return. So one of the big things you want to know when it comes to your rental property is what's the basis of your property. And by basis, that's just accounting terminology for what your cost is. What did it cost you to buy that property? We're going to talk about depreciation in a minute, but this is why you need to know your cost. The adjusted basis is a number you're going to need to know when the time comes to sell the property. An adjusted basis is just your original cost plus any improvements that you made, less any accumulated depreciation. So if you bought it for $200, put 50 into it, depreciated 100, you're down to $150,000. That's going to be the number used to determine your gain or loss when you go to sell the property. I will note that there are some properties that you're not going to use your cost to get the basis. If you receive a property as a gift or inheritance, you're going to use a different way to compute that basis. We're not going to touch on that here. And then we'll also need to keep in mind the land versus the building, and we'll talk more about that next. As I mentioned, basis is needed to compute depreciation. Kind of depreciation is one of the nice things about rental property, in the sense that you put some money down, you buy it, you get it depreciated over generally 27.5 years. Depreciation is writing off that cost over 27.5 years. It's not a cash expense, so it can help generate lower taxable income. A lot of times the depreciation will be what generates a taxable loss, but it's not cash going out of your pocket. Keep in mind that land cannot be depreciated. So two of the big things I see in rental real estate, not breaking out the land, thereby depreciating the entire cost of the purchase. We don't want to do that. We want to take, if it costs $300,000 for the property and the land's worth 50, you can depreciate 250,000, not 300,000. And then one of the other big things I see in rental real estate is really just the failure to take depreciation at all. And that's kind of the worst of both worlds, in the sense you're not getting that tax deduction that you're entitled to. When the day comes, you sell the property, if you didn't take the depreciation and the IRS looks at your return, they're going to pretend you did take the depreciation, and you're going to have a bigger taxable gain than you otherwise would have. And you lose there, because you never took the depreciation, but you got to use the lower basis to compute your gain and pay taxes on. If you forgot, if you made a mistake, something happened in the past and it just didn't get done, you can make a correction. You can file an amended tax return for the last 3 years. And if it goes back farther than that, you can file it for a change in accounting method. You can get yourself caught up and fix that error if you didn't take the depreciation. One of the other big areas in rental real estate is the question of capital improvements versus repairs and maintenance. Capital improvements generally extend the life of the property. Repairs and maintenance, pretty much what it sounds like. It's fixing broken windows, fixing a door, fixing a porch rail. Those are, expenses that come along every year, and it just maintains the property in proper working order. So if you had to repair a roof leak, that's repairs and maintenance. If you did a tear off of the roof and put a whole new roof on, that's a capital improvement. One thing a lot of people ask about is painting. Painting is generally going to be repairs and maintenance. So if you paint an apartment after somebody moves out, you can call that repairs and maintenance. The nice thing about repairs and maintenance, to the extent you have them, is they're current write-offs. You can write that off in the current year. Capital improvement is just like the building, something you have to capitalize and then depreciate over time. So to the extent you can kind of classify things in that repairs and maintenance category, you're going to get the current write-off for the money going out the door to make that for that expense. Income and expenses, and we talked about that on the actual Schedule E. All your rents are income. Advance rent is usually recorded in the year received, but if it's a security deposit, that's not something that's going to be income to you. If it's something you might have to send back to the person leasing the property at some point in the future, you don't have to record that as income until the day the lease is over and you decide to keep the money, if you do decide to keep the money. You're going to want to deduct all your ordinary and necessary business expenses. You're going to want to keep good track of those expenses. One of the greatest ways to keep track of things is have your own separate bank account for your rental property. When you get to the end of the year and you're doing your tax work and trying to figure out where you spent money, if you didn't keep all your receipts or you can't find all your receipts, if you got a separate bank account, it's a great place to look. At least you know if the only thing in that bank account is the income and expense from that rental property, you can put things back together pretty easily. So something to think about. And then when it comes to your income and expenses, if you're have a duplex, you're house hacking, you got a vacation property, is just allocating those costs between your use of the property versus the other person's use of the property. Keep good track of those so you can get all the write-offs you have coming to you. Passive loss rules, I won't go too much into this because it can get pretty complicated pretty quick. But I guess the big takeaways here are rental real estate is considered a passive activity. Whether it's really passive from the standpoint of you don't have to do anything is a different story, but for tax purposes, it's considered a passive activity. You can deduct up to $25,000 in passive losses if your modified adjusted gross income, another fancy tax term there, but basically your adjusted gross income is less than $100,000, you can deduct up to $25,000 in passive losses. That $25,000 deduction phases out between $100,000 and $150,000 of modified adjusted gross income. So once you get up in a little bit higher income range, you may lose those passive losses in the current year. So keep in mind, passive losses, you might not be able to deduct them in the current year, but you do get to carry them over. And if you didn't get to use them during your ownership period of the property, you are going to be able to reduce the gain on the sale of the property. So those passive losses from the real estate aren't lost forever. It just might be a timing difference where you'll get to use them at some point in the future. Some other issues to keep in mind when it comes to rental real estate, active versus material participation. If you're materially participating in rental activities, you may get to put this property more along the lines of a Schedule C type business. Most people aren't in that position unless you own a whole bunch of property and that is your business, rental real estate. If you're a real estate professional, there's some rules you got to deal with. Unrecaptured Section 1250 gain when you go to sell the property. I don't want to go too much into that other than to say that really what it amounts to is some of the gains may be taxed at a slightly higher rate than regular capital gains, depending on your level of income and depending on how much gain there is. So it's just a little bit separate tax system within the tax system. It's not a terrible thing. It just means some of the gain may be taxed at a little bit higher rate than regular capital gains. Ownership method for the property, whether you're going to hold it in LLC or hold it in your own name, is something you're going to want to think about. There's a lot of pluses and minuses to holding it in an LLC, but a lot of people don't like to. When you get to that stage, if you're thinking about how you're going to hold that property, it's something to look into. There's no right or wrong answer. Every case is different. So you just need to understand the pluses and minuses of the ownership there. At-risk rules really comes down to, if you're not at risk for any debt on the property, that's going to limit your losses. So if someone else is holding the paper on some rental property you have, your losses are going to be limited since you don't have anything at risk. Home office use, business use of an automobile. If you're traveling to take care of that property, you might have the opportunity to deduct some automobile expenses. So that's another little way you can reduce your rental income for something you do all the time. And then we got some personal use rules. So if you're using the rental property personally, keep in mind that some of that income, depending on how many days it's rented, you could have an opportunity to have some non-taxable income. And then if you have a lot of rental income or a lot of income, you may have a net investment income tax. So that's just a bunch of things on top there. If you run into some of these situations, you're going to want to take a little bit deeper dive into it. I don't want to dig into all the weeds here today. Quick summary. As we said, rental income and expenses go on Schedule E. You're going to put them into your tax software, and the software will throw it there for you. Compute your cost basis correctly. Make the adjustment for land. Take the depreciation that you're allowed to take. Talk to lots of people. They say, I'll just do it next year. Get it done right this year. Get it set up right up front. And then on a going forward basis, it'll be easy to take care of. As you own the property, look for ways to deduct repairs and maintenance versus capital improvements. There's a lot of information out there on the IRS website as to what qualifies as a capital improvement or a repair and maintenance. But so keep in mind that capital improvements get written off over time, whereas the repairs and maintenance get written off currently. And that's about it. That's just a quick overview of rental real estate. And I wish you the best with your real estate investments, if that's something you're doing. Thank you very much for coming in today. And if you have any questions, there's my contact information again, and throw your questions in the chat. Thank you.
Awesome. Thank you for that, John. So, yes, we do have a question here. This is from one of our attendees. This is from Brian. And his question is, if I buy a rental property, I am aware I cannot depreciate the land, but can I allocate the building into different types of assets with a shorter life than building so I can get more depreciation?
Brian, that's a great question. And as I'm fond of saying when it comes to tax questions, it depends. There may be an opportunity to break out some cost portions of the building separately and be able to get a better write-off. Part of that's going to come down to how you structure the purchase of the property. So let's say you go out there and buy a building and it includes all the furniture and fixtures and all the light fixtures. And you say your deal is for whatever, pick a number, $500,000. You may have a little bit tougher time breaking out, well, how much did you pay for the furniture and fixtures? The better way to structure that deal would be to say, look, Mr. Smith, I'm going to pay you $400,000 for the building and $100,000 for the furniture and fixtures. Then it becomes a lot easier to say, hey, $100,000 of that price is furniture and fixtures, and you can write that off over a much shorter time period than the building itself. So from your end of the deal, trying to break out those costs is better for you, and the buyer's end of the deal, he may want to have it more allocated to the building. So that's just going to come into the negotiation if you're at that stage. After the fact, gets a little bit more difficult, but there may be ways to what they call cost segregation. And if you can work that out with somebody who knows what they're doing, it's worth taking a look at. Good question. You're muted.
I'm so sorry. Sorry about that. But anyway, yes, we do. Thank you so much, Sean, for that great answer also. We have another question. This is actually from our live viewers in Facebook. And his question is, if I rent out part of my house, do I allocate my interest expense, maintenance, and property tax based on square foot or number of rooms or some other method?
Okay. So if you rent out part of your house, how are you going to allocate your costs between the rental part and your part? And yes, you can allocate the costs. You need to come up with a reasonable allocation method. Two methods that the IRS um, comes up with are number of rooms or square footage, and you have a choice of doing it either way. So if you have 4 rooms in the house and one of them's rented, 1/4, pretty simple. Or you take the total square footage of the house, how much square footage is being rented. And keep in mind, um, let's say you live, let's say you have a 2-story house and you rent out the second floor and you live on the first floor. Go ahead and take, if they're both the same square footage, 1,000 and 1,000, it's 50% rental, 50% personal. And that's the way I would typically do it. It can get a little bit interesting as far as allocating that square footage if you have shared spaces. And you're just going to want to keep that in mind. You know, looking at the shared spaces is really going to be personal use versus rental use. Um, a lot of times the square footage can come out better versus just the rooms, because you got a number of room, whereas if you do square footage, you can maybe include hallways and bathrooms in the square footage space. So you got a couple ways of doing it there. Neither of them are wrong. Just look at it, work it out, and see which works out best for you.
Okay, well, thank you so much, John, for that wonderful answer. That really helps. Um, that is actually our last question for today's session. Anything else that you want to add or any takeaway for our audience?
Sure. Well, thank you everybody for attending. Again, if you have questions that you didn't want to ask today and something comes up later, feel free to contact me at Tax Resolution. We're all about helping you do it yourself. We love educating you. We're here to help educate you at a nominal cost if you want to sign up for the program. And then we're also here for you if you get to the point you need some professional help. You want somebody with experience. We got a lot of people here at Tax Resolution Center that have just years and years and years of experience in the tax, real estate, accounting area. We'd love to help you out, but we're really here to help you educate yourself. And again, if you get to the point you need professional help, we hope you can contact us, and you've got a name in your back pocket if you need somebody. So thanks again for coming today. You're taking a great step here trying to learn about this.
All right. Thank you so much for your time, John. I which really also appreciate your time and also sharing your knowledge and giving us a real life examples. It is really helpful for our audience, also for me. I've learned a lot. Thank you for your time again. Have a wonderful day. I hope you can rest after your skiing. Okay.
Thank you.
All right. Bye
Bye.
bye. All right, guys. I also want to thank everyone for attending our session today. We truly appreciate you coming every day, every week for our session. Our commitment is to help you reduce your taxes and, of course, increase your wealth. We do this with the TriTax method, DIY, do it yourself, DIT, do it together, and DIA, do it all. Three methods, one solution can reduce your stress from no IRS or state tax debt and a happier, healthier life. If you are not yet a member, please join for less than $20 per month. We need your support to continue to offer more of these sessions. And since it is now tax season, we have many sessions to help you do a better job of doing your taxes yourself. And of course, if you want help, we have our team of experts who can do your tax return for you. Please check our website at taxresolutionhelpcenter.com and please join as a member today for only $19.95 per month. And again, thank you all for attending. See you for our next week's session.